Hey guys, welcome back. Just running off the last video about the key terms and definitions, I thought I'd run through a quick video of applying it into your business and into practice. I am share screening a actual profit and loss and down the bottom here, a balance sheet from a real business. This is a building construction industry business. These are the financial reports directly printed out from your Xero, so nothing fancy, nothing that you need your accountant for. You can simply go to your profit and loss tab in your Xero file and your balance sheet tab in your Xero file as well. For everyone using other software, most softwares have the exact same structure behind it. This is a profit and loss report and a balance sheet. You'll be able to get it through MYOB, QuickBooks, and any other software that you're more or less using. So again, running it from the top, when I was referring to our revenue, our top line, our turnover, this is what I was referring to. It is our total sales generated. It is everything that they have earned with no expenses put into that particular amount. Moving down to our cost of sales, when I was referring to right underneath it, these are direct costs. This is a very nice and simple example, which is why I've chosen it. Hence, if you've noticed the reductions, this is a legitimate company. And this is a very simple version of a cost of sales. There's multiple examples. You can make this as detailed or as simple as you like. These particular clients like it really, really simple. It gives them the information they need or they want, and they can work around it. So what they have included are contractors. They've put the direct raw materials that they refer to as purchases, and they've got all their staff members included here. A lot of their staff members are non-office bound. They are literal workers, tradesmen on site in factory, ready to go. You'll notice down the line as well, we've actually separated the associated wages here. So associated wages are excluded. A lot of the owner's time is spent networking. It is spent in the office drafting, quoting, outside of the direct cost of actually going on site and producing the revenue, which is why it's been excluded as well. So this is where our gross profit gets involved. We've got some other income that's more or less produced. They've got some apprentices, they get some apprentice subsidies and some interest from some of the money that they have on in their account that they're earning throughout the year. Everything else will more or less fall down into the operating expense component. You'll see fees to advertising, to bank fees, to depreciation, to general expenses, insurances. Some people like to put the fuel and their motor vehicle costs in cost of sales. These particular gentlemen do not want it there, so they like to have it here in the operational expenses, office supplies, rent, everything else involved in running their business, right? Again, the point I'm trying to make here is there is no one right way of doing these reports. You can customize these to however you like them. You can be as detailed as you like, as simple as you like. The purpose of it is to categorize it more or less as correctly that you need it for, so that you can get data and you can make business decisions from it. Leave the accuracy to the ATO, leave it to your accountant, let it report to the ATO how they need it. As a small business owner, your job is to understand your finances to make future decisions to help your business grow. Using simple reports like this and simplifying it will give you the best chance in doing so. Do not overcomplicate it. So down the bottom here, we'll have obviously our total operating expenses, and then we have our net profit. You'll also notice last year they took some dividends. They will be reported underneath there. And all of these, of course, have different tax treatments. But for the purpose of what we're doing it now, this is a very simple, a very clean, and a very great example of some of the core, I guess, terms that we were referencing in the last video. Moving down to our balance sheet. You'll notice, like we said yesterday, our current assets include our bank, our accounts receivable, and most of you should notice a cash on hand component. So cash on hand is what your shares are worth with ASIC. So this is what you would have, or your accountant would have put down when you were setting up. Traditionally, this amount was actually put in your constitution and your register and kept on file. A lot of the times we keep the amounts nominal and it's just there as an accounting transaction. So keeping it nice and simple. We have our non-current assets, which are fixed assets over here. We've got our motor vehicles, which have been fully depreciated, our plant and equipment, which has been fully depreciated, hence giving us a nil. nil accounting balance here. We've got some non-current loans. So in this scenario, a director took a personal loan from the company for a motor vehicle. Yes, that has the Division 7A consequences, which they are aware of. We've got some preliminary expenses during setup. There's a bond on their rental. Got some borrowing costs, which have been amortized. So everything's a nice clean tick. We have our total asset balance over here. You'll notice here, which is our current liabilities. Most businesses will have very similar amounts. So they previously had a small debt as at 30 June 2023 for their ATO integrated client account. So this is when you incur your BAS debt. We like to post it to a separate account where we know what you owe to the ATO. A lot of the times it can be a bit of a timing thing. So they may have lodged it June, paid it July, hence showing up as a liability come 30 June 2023 in this scenario. The directors did put in a little bit of money that they're slowly paying back to themselves, which is a loan to themselves. They've got their GST liability accruing here, got their pay-as-you-go withholding accruing here. There's a superannuation payable accruing here. So these are all, I guess, in debts that they're incurring. These are taxes that they're constantly incurring. You can keep track of your balances there as well. Child support payable, there was an overpayment here that they're currently dealing with Centrelink for. They've got their credit card balance that they owe. So you'll notice all of these liabilities are all coming up within the next 12 months. So all of these amounts need to be paid. So then we go back to our, call it current ratio even. If we go our total current assets, even if we just use the money in the bank, 138,000, this business is in a good position because their current assets more than covers their current liabilities, meaning that even if all of these debts were called in tomorrow, they could meet them and then continue to trade. A really good reference point. So understanding this balance sheet component is really, really important. So now they've got some long-term debt here that you'll notice, our non-current liabilities. So they have a CNC machine, which is quite expensive, so they financed it. So we include the total debt amount, and then we deduct the interest costs and the borrowing costs over the term of the loan. As you can see it decreasing there, and as accountants, we record that interest expense year on year. Same thing with the panel saw, much smaller amounts. That looks like it has or will get paid off in the early in the 25 financial years, $50 of interest left to claim, and then an LDV van as well. You'll notice some prior year balances here. So what this means is that the vehicles have been paid off or sold, but I know this client, so it has been fully paid off. So that more or less gives us our position. So now we've got all our liabilities in place. Their net assets in this year was positive, meaning that they could meet all of their liabilities, short and long term, with the current assets and cash they have on hand, and still be able to operate into tomorrow, which is a really good position to be in. And that more or less simplifies our profit and loss and balance sheet. I've tried to hit as many key terms that we spoke about in the first video as I could. This is a really, really good way to start analyzing your own accounts, break it down, and start shifting it to how you like it. A lot of the time, it's really good to relate it to some strategic points and things that you would have picked up during your strategy session when you ran through with Jordan last week. But print these out, go to your zero, go to your MYB, select the profit and loss, select the date range. The biggest tip before you do this is make sure all the transactions are allocated. Make sure everything's up to date so that when you're looking at these, the data is accurate. Good luck, guys.